In recent months, the steady rise in oil and gasoline prices has prompted a plethora of media commentary. Crude oil currently sits above $70, nearly $30 higher than pre-crash levels. The current narrative depicts a U.S. saddled with high oil and gas prices, which, should they continue, may harm the economic recovery. This has subsequently led to month after month after month of calls by the Biden administration for OPEC to increase production to ease price pressures. There are now price gouging accusations as well. This narrative has sold the idea that the U.S.'s oil supply is a paramount concern, but the actual concern has much more to do with what is provided in exchange for that oil, the U.S. dollar. With the media now working overtime to tell everyone about inflation that's existed for months now, one would be remiss to see that the dollar's strength is currently at a one-year high. The dollar, like any other commodity, also has a valuation that bends to the laws of supply and demand, and higher dollar demand around the world has pushed its value higher. Foreign nations not only demand dollars to service massive dollar-denominated debts, but to purchase oil as well, which brings us to the Petrodollar System. This system, installed after the full repeal of the gold standard in the early 1970s, has underpinned all U.S. budget and foreign policy since. Through this system, oil traded in the international market is priced in dollars, which requires a purchaser to exchange their currency for U.S. dollars before buying oil. In this sense, there is disproportionately high demand for the U.S. dollar, as its value is backed by a large part of the global oil trade. This is on top of the demand that it enjoys from being the world reserve currency. So why would high oil prices be supported? Through 2020, the U.S. government saw its broad money, M2 money supply, increase by over 20%, and the immense spending measures taken had multiple effects, via stoking inflation and manifesting a supply chain crisis, as demand recovered far faster than supply in numerous markets. Oil saw this effect vividly. Demand has largely recovered, but OPEC still has production set to a significantly lower level than before the market crash, in a stated attempt to normalize inventory levels. Compounding this is that as the U.S. inflation rate creeps higher, so does the price of oil. As explained before, the dollar is backed by oil trade. When foreign countries are forced to trade for dollars, while the U.S. experiences high inflation, they are preventing those devalued dollars from chasing other goods. In effect, they are importing inflation that the U.S. is exporting in dollar form. Therefore, it is essential to the U.S. economy for dollars to continue to be in demand globally. For a country where the rhetoric has been to not produce more oil or to negate its use entirely, the salient fact is U.S. oil production, while lower, is still at late 2018 levels, but oil exports have risen precipitously. The United States, with all the public clamoring for more oil and tapping its reserves for domestic consumption, has quietly increased its exports while OPEC reduced supply. High oil prices and oil exports are at the forefront of an implied effort by the U.S. to store its inflation in the price of global energy.